And then, hi everyone. Today we're going to talk about debt modeling, debt structure. As you know, like the webinars is very short, so the idea is really to give you an overview of the topic, okay? And then if you have questions, is to give you some highlights of a topic, and then if you like to know more in detail, then the idea is that please come to the course, so then you can find out more in more detail what we mean, and how to go about the modeling side, the theory side. But here we only have 30 minutes, so we just want to give you a snippet of what the topic is about. And then if you have questions, please do ask us, or do come to our courses, email us. We're here to help you improve your understanding of real estate finance, financial modeling, and have fun as well. So let's go. Um, the topic for today is advanced debt structures and dynamic loan modeling. And the idea of being advanced, always when I say about advanced modeling, is when we have to add dynamics to financial models. Okay, that's always the bit that becomes a lot harder to model, because you need a lot more scenarios and a lot more what ifs. And this is the advanced part of modeling, because as you know, it's so much easier just to hard code everything, just put the same scenario over and over again. But as we understand, especially in the private markets, we have always some kind of bespoke features. Even if it's the most simple debt facility that you can have, there's always some kind of nuances there when you draw down or when you pay the fees and so on, that you need to model. So that's when it becomes a lot more complicated, because not everything is the same all the time, right? And then the beauty of financial model, the beauty of building in Excel, is that it can have flexibility portraying everything that happens in the deal. Right. So the idea here is to give you a high level. As I mentioned, 30 minutes is not a lot. I've already spent 10% of my time explaining to you what we're going to talk about. So it's a high level webinar to modeling interest only periods, bullet repayments, tiered financing for finance professionals and students. Okay. So the idea here is mainly to give you an overview, and hopefully that gives you some insights in what you can do in terms of your own modeling, your own understanding. So as you know, my name is Maria Widner. I'm the CEO and founder of Cambridge Finance, and Cambridge Finance we specialize in financial modeling, and we specialize in real estate, all like on the trading side and also on advisory side. This is what we do for a living. This 30-minute duration, this webinar, and then it's going to give you a high level approach because it's 30 minutes, but there's always, scope for you to ask more questions and follow up with other webinars. Right, so here we're going to talk about the elements of that structure. And as I mentioned, it's pretty much talk about interest only and bullet payments. Terminology is also important in our industry. What is interest only? What is bullet payments? And so on. And then the building dynamic loan schedules. I'm just going to show you how I build. So if you like how I build, please ask the question as well. We don't share our models. Okay, don't ask us this. But we do help you if you want to get some information about how you can improve and how to make more efficient your model. We're happy to do so. But the idea is to make your debt facilities, your loan repayments more dynamic. And then techniques for accurate cash flow forecasting is one thing about financial modeling is that it's really the forecasting. So it's always forward looking, is what we call our crystal ball. So the more features you have, the more dynamic it is, the better you'll be your decision making, your risk assessment of the deal, of the loan. Okay, so I hope that's clear. So the introduction here. The introduction is pretty much how we're going to borrow and how we're going to pay back the loan, right? So when we have interest, when we have real estate project. We're gonna buy land, build a shopping center, build a hotel, build resi, whatever it is. It is a capital project, so it's a huge amount of money, and then therefore we need to raise that because that's a way for us to leverage the asset, leverage the investment. We can buy more, we can build more, and also it's a way for us to diversify. So also there is another way to look at it is that, you know, I have my own money, but I can use that in order to diversify. Instead of just using one project, I can use in two projects, three projects, and so on. So that's why that is very, very important in our industry. And then here we're going to talk about two main types of repayment schedules, which is the interest only period. As the name says, we pay only the interest. And then we also have the bullet payments or balloon payments, which is the one that it's also another terminology here, payment kind or bullet payment or rolled up interest. Okay, so we're going to talk about it. And then tiered financing is pretty much like the capital stack, is how we deal with the waterfall. So in last webinar, we talked about the waterfall specifically. Today, we're going to talk about the debt structure and this how this capital stack works. But with the waterfall, how we pay back the different trenches is the topic of the webinar that we spoke last week. So tune into that part of the webinar if you want to find out more. But here we're just going to talk about the interest only and the bullet repayment. Okay. So when we borrow money, there are going to be some conditions there, how we're going to pay back. Okay. So money is not for free. So if you borrow 100, you have to pay 100 plus something. And this something is what we call interest. In our country, well, in the Western world, in Europe, we call it interest. If you're doing Sharia finance, is a profit share, is another name, murabaha, if you're doing Sharia finance. But the idea is that money doesn't come for free, right? So then we have to pay some sort of interest, like a profit on top of it. And that's what we call here interest. So when we talk about interest only loans, it means the name says it. It's like, so you're going to borrow 100, you're going to pay back 100, and in the meantime, you're going to pay back the interest. So it's the fee for the money. And then if you, for example, you borrow 100 and the interest rate is 10%, so every year you have to pay 10 every year, and then at the end you're going to pay 10. So this is tends to be the most basic type of loans, because at least you are paying back your interest, right? In terms of borrowing from a real estate perspective, this is actually quite good because you're not paying everything, like you're not amortizing. So it's not like a mortgage that you're going to fully amortize over the certain period of time. It is you pay the interest. So from a borrower's perspective, it's a good type of loan to have because you don't have like a lot of repayments is your interest. However, from a lender's perspective, there's still like a big of a risk there because there is no reduction in capital. So if you're gonna borrow 100 and the value of the building says 150, right? At the end, you're gonna still pay the 100. However, you know, and we know that sometimes the markets go up and down. And for example, you borrow 100 with a value of 150, but then at the end, the value of the building might be 75. Then that means that it's still like the capital value at the end that the lender is very exposed to. So there is a big refinancing risk or repayment risk, and therefore the interest is going to be a little bit higher because the risk is a little bit higher than if you, for example, you amortize it, you repay this loan over the loan period or the maturity of or the loan term that we call it. Okay, so this is one of the features. So it's interest only period. And again, if you are coming to the modeling class, then it is it is a part of the course. But that we're gonna model this. Maybe I'll show you here how does this model, if I have the model here in front of me. Yeah, so the interest only here. So we have this loan schedule, and with this loan schedule, so here we have the interest only facility, and then this loan schedule, the interest is you are gonna have, you can have a floating rate or you can have a fixed rate. So if your fixed rate is, for example, 6.5%, then that means that every year you're just going to pay 6.5% of the loan. Okay, so this big formula here is actually just saying, well, if your interest rate is 6.5%, then you're just going to get like the loan amount times 6.5% times the year frac. So year frac is the fraction of the year. So it means that when we are modeling, then you're gonna say, okay, if it is your cash flow is for 1 year, then your year frac is gonna give a fraction of your year is gonna be 1 year. But if you are modeling on a quarterly basis, then your year frac, the fraction of the year is gonna be 0.25. So that's what the year frac here is doing, is just like dividing by 4, for example, or divide by 2 if it's a semi-annual cash flow, or dividing by 12 if it's a monthly cash flow. Okay, the only thing with the year frac is that's a complexity of it, is that it's going to count specific with days in mind, and then days have also conventions, how many days there are in a month. It's always a bit complicated, but that's the idea. But in simple term, it means that the year frac means that if it is annual cash flow is going to be 1. If it is semi-annual cash flow is going to be 0.5. If it's quarterly, it's going to be 0.25. And if it's monthly, it's going to be 1 divided by 12. Okay, so that's the idea of year frac, because you're not going to pay 6.5% every cash flow. It's going to be paid every quarter, monthly, and so on and so forth. Okay, idea of modeling interest only. So interest due is what, 301, and then interest paid is the same. So whatever is due in that period, you're gonna pay. And then here you might be wondering, how come there is a reduction here? Oh, it's because it's a floating rate. So if it is a floating rate here, right, that means that our expectation here is that the interest rates are coming down, fingers crossed. Therefore, the interest rates are going to reduce. But if I change here to fixed interest rate, then we should see here that the interest rates will follow more or less the same pattern. The only thing is that there is a fluctuation because it depends on the number of days in each month. So if it's a month with 31 days, then it's going to depend on the convention of the day count convention that we call. So it's all simple, but then the details is what gets to us, isn't it? Right, so that's the interest only. Whatever is due, you pay back, and then at the end, your residual is the amount of money that you borrowed. Now, bullet repayments, right? So that means the bullet. And I like the bullet because it feels like, at the end you get killed, somebody's gonna, shoot you at the end. But that means that is the bullet, it means that all the repayment is going to be at the end here. So that's the bullet. So, or the lump sum at the end, or the balloon payment. It means that there is no repayment in the middle. There is no interest, and then all the interest is going to be capitalized, right? The interest is going to be capitalized in the principal, and then you're gonna pay back everything at the end. So why would you do that? Like, why would you be exposed to such a high it's more the high risk of the lender, but also if you are the borrower, it's better because you don't have to pay back. There's no cash outflow in the meantime, but that means that the interest rate is going to be very high because the lenders are going to face this risk of you not paying them back. Because if you use the same scenario that we did before, you're going to borrow 100 for the house to be 150, and then at the end, if the house is 75, for example, you don't only have to pay back the 100, but you also have to pay the 100 plus the interest. And then sometimes the interest can be, the same amount of the principal, depending on the level of interest rate and so on and so forth. There is a Q&A question here. What is the difference between interest only and bullet repayment? It looks the same. Okay, so now I am explaining what's the difference. So the bullet repayment is one that you have no payment in the middle. Everything is the payment is the payment in kind. So there is nothing, no cash flow. That only happens when we have development. So development is the time that we borrow in this scenario. Why? Because we don't have inflows, right? So we don't have rents to pay back the loan. So therefore, we need to use this kind of loan facility, right? So sometimes people call it like the construction loan because it is a feature of construction loan because you're still building. There is no income to offset any of those payments. So therefore, this is the bullet repayment. Okay, so there you go. And then from a borrower's perspective, so we don't have to pay back anything in the middle, but then there is a big exposure at the end. And like that's really like the risk because at the end, your capital value, the building that you built, or yeah, mainly is the building. Once you sell it or you refinance it, it should be enough to pay back for the principal and the interest. So I hope that's clear now. And this is one area that these days people say that a bit worried about, a bit nervous, because there are no covenants as such. So if you check, because there is no income, they can't check, okay, the income, there is vacancy, there is no vacancy, there is the costs are too high and so on and so forth. No, because everything is at the end. So sometimes the lender would just say, okay, I'm going to close my eyes, hope for the best. So then at the end, you can pay me back. And that's the feature of this bullet payments, this kind of construction loan. Okay. You can read here, bullet repayment, a large lump sum payment due to a specific point in the loan term, often maturity. It represents a significant portion of the principal that remains unamortized. So amortization, terminology again, it's all about terminology. Amortization means a reduction of the principal. So you borrow 100, and then if you pay back your loan, amortize it, the principal, then at the end you might pay, for example, 50. So it's amortizing, but this is not amortizing. You're not paying anything back. On top of it, you have to pay back all the interest that you haven't paid in between time. Cash flow impact reduces the periodic debt service during the long term, but creates significant refinance requirements. There you go. And this structure produces uneven cash flow profiles that must be carefully modeled and stress test. And the stress test is pretty much on the value at the end. So are you going to build enough to pay back the loan? Okay. And then the risk consideration, that's a massive risk consideration, which is, are you able to pay back? At the end, if you are building, if the capital value is enough to pay back for your principal and the interest and the fees and everything else. Okay, well, there you go. Now to the tiered financing. Tiered financing is the capital stack. So I think if you've been on my webinars here, we've been going through this capital stack over and over again. But it's important because when we are developing projects, we need to find out where this money is coming from. So once upon a time, when I started practicing, we could borrow like 99% from the bank, for example, like it was the free money. But it has changed over time, especially with the financial crisis of 2008, 2009. And we can't borrow that much from the bank. So we borrow 50%, 60%, and then what happens? Then you're going to need to bring in other types of finance. So your equity is very important these days. So your own money. And now there's not only your own money, but you need to bring somebody else's money. So you have to bring like another rich investor to partner with you. And normally this partnership tends to be in a what we call joint venture, right? And then we have the promote structure, we have the carried interest. So these are terminologies that we use when we're looking at profit sharing in joint ventures. And then we also need to find out not only the loan from a bank, the senior debt that we call, but also a junior or mezzanine finance. So this is like the second charge on the land, for example. Okay, so this is what we call the capital stack. So if you think about how we're going to finance it. So if you have 100, for example, you're going to find of construction costs and land, then you're going to find finance. So for example, 50 is going to be your senior loan first charge. If you sell it for 50, you have to pay back the 50 from the senior loan. If you sell it for 80, you pay back the 50 to the senior loan. If you sell it for, but it's the senior is the most secure, and then you have to pay back first. And then you have the second charge, which we tend to call these days mezzanine debt or junior debt, right? Is the second tier. So if you borrow 100 and then 50 is senior, if you borrow 100 and then you sell it for 200, then your senior debt is, for example, 50, then your mezzanine debt is say 30. You still have to you can pay back if you sell it for the same 100, right? But if the values go down, then the senior gets paid first. Whatever is left, you're gonna pay the junior, and then you're gonna have the preferred equity and the common equity. So preferred equity and common equity in the private equity organizations is what we call the GP and LP venture, joint venture, which is the GP is the sponsor, so is the developer, and then the preferred equity, it tends to be the LP. So then they'll say, okay, it's preferred equity because they have to be paid first. Okay. And that's how we work out this tiered financing or the capital stack. And then there is a priority of payment. So senior debt first, mezzanine, preferred equity, and common equity. That means that the further up you are, well, the further down you are in this priority, but here it's in their capital stack, the further up you are in the loan to value, the riskier it is, and it's going to be more expensive. Okay. So the senior debt tends to be around 15, 65%. I agree with it. And then mezzanine finance is going to be 65 to 80% loan to value. Preferred equity is going to be the next tier. And then the common equity is going to be the 10% or 5% that normally happens. Okay. The challenge in modeling it, as we always say, is the what if scenarios. So you're gonna have to model the waterfall. So first it's like, what if you sell it for more than the senior, then you pay the senior. What happens if you sell it less than the senior? Then you have no money to pay, then you have to find money to pay for it. And then if you sell it for more, but then it's enough to pay the junior, the mezzanine, and so on and so forth. So there is always this kind of what if analysis. If you can pay, when you're gonna pay, how much you're gonna pay, right? So that's always the modeling challenge. But we teach everything. If you come to my class, hopefully you come out with this idea of doing. Let me just answer the Q&A. I quite like this session today because we have lots of questions here. So I answered the first question. So negative bar should include interest as well, which is not the case on the projected graph. Yeah, so my projected graph, you are correct, Pierre. It is the capital and the interest. So here, I think it's the capital and the interest should be also here. So maybe here my chart is not. Just look at here as in the interest is missing, but you do have to pay both of it. I was in a hurry. And then the numbers are going for the finance trans cumulative. If not, how can the borrow more than 100% of blah, blah. Yes, it's so here it's the loan to value, right? It's not cumulative. It's like, so the 50 to 65% you go to senior loan. From 65 or from 50 to 65%, like the next bit here, let me see if I can write here. So this is the first 50. Then if you say you're gonna borrow 20%, then it's gonna go to the 70% loan to value, okay? And then if you're gonna go, say you're gonna borrow here 10%, then it's gonna go to 80% loan to value. And then if you're gonna need to borrow here 20, then this is gonna go to 100% loan to value. So this is the idea of riskiness, because if you sell, for example, for less than 100, then your equity goes, right? So say if you sell it for 80, then your equity goes, then you only have money to pay preferred equity, junior, and that. So that's why here it's showing here as in the percentage of loan to value, because a drop of say 10% is going to eat up your common equity, because there is a waterfall, there is a priority here. It's not what we call the pari passu, that we're going to share, you know, the loss. No, we don't share the loss here. Okay, I think this is now. How do I don't want this anymore. Now I need to go to my. See, there is good to write, but then I need to unwrite here. So I hope you paid attention, because now I need to erase everything so I can continue. So I know what to tell you about. Okay, so this is the capital stack, building dynamic loan schedule. As I mentioned, so robust input selection, and section, formula-driven calculations. If choose for to toggle, I use the choose function, and then to implement this waterfall. Waterfall is always a function of min max, as I mentioned, and then the scenario analysis is also a way for you to check, you know, like if you have the interest only, if you have like a bullet payment, and so on and so forth. So here in my model, for example, the dynamic scenario here to toggle, I use the choose function. Okay, so I choose what happens if you are in an interest only. So choose the interest only schedule. What happens if in a rolled up interest with a bullet? What happens if you're in an amortizing scenario? What happens if you are in amortizing, fully amortizing? What happens? So we go through all these 5 scenarios here. So interest only, constant amortization, constant payment, fully amortizing, and constant payment with the balloon payment, and the rolled up, which is the bullet payment. Yeah. Let me see there. Lots of questions today. There's also a good question here. Thank you. Would you usually be looking to achieve lower interest rates as you de-risk the development? Yes, but once you can't keep negotiating your interest. Once you need to get a loan in the beginning, because the lender would say, you know, I'm gonna give you the loan for you to complete this development. So even though you're trying to achieve lower interest rates, is not always possible. The way to achieve lower interest rates is when you refinance at the end. So you pay back the loan once you build it, you achieve practical completion, and then you're going to generate what we call the implied equity, and then you can refinance it, and then you will start receiving rents, for example, and that's the time that you de-risk your development, because you have already a building, you have already value, you have already tenants hopefully there, or you started selling the houses, and that's the way to de-risk it. But throughout the development, is quite unlikely that, well, it shouldn't happen that you're going to start the development with just half of the money, right? Like you normally going to have to, once you start building it, you need to make sure that you know where the money is going to come from, or at least like if you're going to borrow money, they're going to say, okay, this is how much you're going to need to build it, because otherwise it's quite unlikely that lenders are going to give you some part of the money without the knowledge that you're going to be able to finish the development with that amount, right? And what they don't want is like to have a half finished development that you can't capitalize on it. The only thing you can do is sell it, but that's not what the business plan should be. The business plan should be that you develop fully, you rent it out, and then you sell at the end as a stabilized, amazing development. Okay, so that's a successful development business plan. So there is no way to like start with 50% of the loan, and then as you de-risk the development, you're gonna borrow at a lower rate. That is not normally the case. But you're going to refinance it when you de-risk, when you complete the development. Hopefully that's clear. Let me see how many minutes I have. We finished. Okay, so there you go. So that's the dynamics, and then step-by-step loan modeling. So we have, I mean, we can't do this in 30 minutes, not even like in 2 days that I from 9 to 5 that I covered this modeling. You can finish it. But the idea here is that you have, I put in orange here my inputs, and then here you're gonna have the covenants outputs as well. So they can be like different scenarios as well, interest only, constant amortization, bullet payments, and then the structures output, like how your development or your investment is going to turn out. Like this is not a development, this is already an income producing asset. But then like what is going to be the IRR and PV and so forth once you start adding debt, and at what kind of level of debt you're gonna add to your investment, right? So it's going to be 50% loan to value, 60, 70, so on and so forth. That will have an impact on your returns. Build complete schedule, that's what we do, and then layer multiple facilities, that's what we do as well. So there is this what if analysis. So what happens when you go from interest only to constant amortization to constant payment and rolled up interest and so on and so forth. Techniques for accurate forecasting. Well, the technique is for you to understand everything that is going on. That's the most important thing. Like you understand the facility, you understand when you're gonna borrow, when you're gonna pay back. That's the fundamental way to model forecasts. Is if you understand the business case. So you can be an excellent modeler with lots of if analysis and mean and everything, but if you don't understand how this loan facility works, then it doesn't matter. There's no way you're gonna actually build anything because you don't understand the what if analysis, okay, and how we're gonna pay back. So that's also the very important. The minute you start modeling, understand the business case first, because that's the only way you're gonna calculate an accurate cash flow, because you can forecast and you can foresee what is expecting, what you're expecting to see there, and also you know what if there's a mistake there, because you know what to expect. Okay, so that's the most when I say about accuracy is I mean you have to understand the business case. Takeaways. So I think my takeaway here is that you have to understand uh, what the real estate side is doing. You understand what the lenders want from you, and then model everything. So then the forecasting is accurate as can be. And by accuracy means that it follows your business plan and you understand the business plan, right? Because that's for me the most important part. Because if you don't understand the business plan, you don't understand what you're building, how you're building it, then there's no point in creating a financial model, because then it would just be numbers around that you have no idea if it's right or wrong. Okay. Flexibility is important, but flexibility requires a lot of knowledge, okay, scenario knowledge and so on. So we start very simply. If you're starting now your journey with financial model, start very simplistically and then build from there the what ifs, the waterfalls, and so on and so forth. And then, of course, always inviting you to come to our courses. That's where, I really sit down with you and explain if by if, or by or, sum by sum, right? So we're gonna have one starting next week. So if you can, and if you'd like to join us, please do so. It's your time. It's now or never next week. And then you're done. Like you can really learn everything in 1 week and become very proficient on investment analysis, financial modeling, creating business plan, understanding business plan. Okay. It's going to be in London, or it's going to be online as well, depending on where you are in the world. And thank you so much for attending. And I appreciate your time here. We didn't go through AI applications for real estate. I borrowed the slide and it didn't change it, but I hope you enjoyed the session. Please contact us. Yes, it's great to see you here, your name at least. But it's good to be in touch. So if you like to grab, you know, coffee, virtual coffee or whatever, please let me know. And I hope I see you in our courses online, next webinar, by email, sending questions. And it's been a pleasure. As you know, I love sharing my knowledge as well with you. And I hope I had more time, but it has to be quick and sweet and give you an overview of the things that we are going through in our business here at Cambridge Finance. Okay, so great to see you all, and I'll see you around in our course, next webinar, and so on. Thank you, everyone. Have a great week. Bye bye.